And on hand to help us break down the newest breakthrough in the trade negotiations are Jeffrey Tucker of the American Institute for Economic Research and Todd Horwitz of Bubba Trading. Gentlemen, welcome to the program. So Todd, let's start off with you. The outline of the agreement is quite similar to what was reached in late 2018 after the first trade summit between Trump and Xi. Did anything actually get done here, as previous talks also yielded the exact same results, where we were apparently 99% of the way there, with the last 1% to be the most material disputes? So did anything actually change here aside from just sentiment?
No, nothing really changed. I mean, this deal is almost laughable on its face, the way it looks right now. I mean, this is just, they're not even buying as much agricultural goods as they were buying normally. So, to look at this deal and say it was a huge success, on the face of it, the answer is no. If you look deeper in some of the other arrangements we have with them, it might be okay. But again, this is not what the street was expecting. This is not what we would call major progress on trade, but companies will start to buy because I know they have at least a 60 to 90-day window to get some things done. But overall, to me, the deal was a non-event and no big deal yet. This is not what I'd be looking for a final deal.
And Jeffrey, as part of the terms agreed in principle so far, China has agreed to increase its purchases of U.S. Ags and Boeing aircraft, in addition to now making substantial reforms on intellectual property and financial services. The U.S., though, has agreed to just not raise tariffs from 25% to 30% in October. So does this sound fair, given that China has offered this much concessions, but in return has received very little? And what did China get in return for all these concessions?
Yeah, well, I agree with Todd that this is all just symbolism and really a bunch of flim-flam, really. There's not really been anything substantial here. As for the intellectual property issue, we're nowhere even close to resolving that. But what I find most interesting about this so-called phase one is that what it in effect does, and hardly anybody's even talking about this, it codifies the U.S. tariffs against China, and which are egregious taxes against Americans that have been imposed over the last 18 months. It's just outrageous. It's like a second level Smoot-Hawley kind of mercantilist policy. That is not even discussed in this deal at all. Basically what you have here is China desperately trying to reserve its customer base, and the U.S. desperately seeking buyers for its overproduced agricultural goods that are heavily subsidized. That's it. There's nothing else going on. We're not seeing any budging at all on the part of China concerning industrial subsidies, much less intellectual property, and no movement on the U.S. in terms of the tariffs that are already in place. Trump said it. He's a tariff man. Tariffs going to stay.
And Todd, it looks like the markets are actually catching up to this. Oil prices fell more than 2% as now the details emerge about the first phase of the trade deal. And now the oil markets seem to be taking a lot more of a cautious stance than the equities right now as to what comes next, given the issues of industrial policy and IP were, as Jeffrey just said, were not addressed. So is it possible for this deal to just fall apart all over again?
I don't think it'll fall apart, and I don't think that it's such a big deal on what the tariffs are, because China has made the arrangement for us to buy goods. The real problem comes for us exporting goods, because we can buy, they've already reduced their currency. But when you look at oil, we have a glut of oil. There is so much oil, and if you take the oil we're producing here, we're a net exporter. You take the oil worldwide, and you take the worldwide global recession right now. I mean, every nation is in a recession right now except the United States of America. And I think we're in the very early stages of it. So you've got a glut of oil, and that rally last week in oil was only based on some fear. I mean, all you have to do is look at the pricing of oil, and if you go out 3 months from now or 4 months from now, oil is about $1 cheaper than it is today. So this is only being fear trading that's even keeping oil where it's at. So I look for oil to go significantly lower from here. I think it has nothing to do with the trade, because at the end of the day, there is such an glut of oil in the system that we can't use it anyways. It's going to be the same thing as if you look at the grain markets, that there's been an oversupply because there's been no events to disrupt supply. So if you look at it from that standpoint, oil should go lower, and probably will continue to do so.
Now, Jeffrey, as Todd just mentioned, the entire world has kind of fallen into a recession because of the trade war jitters. So we see that China's export fell for the second month in a row in September by 3.2%. So with the tariffs of $365 billion of Chinese imports still in place after this round of trade talks, will China resort to depreciating the RMB again to stop the decline in exports?
Yeah, I'm not sure how much control China really exercises over the value of its currency. The markets are overwhelmingly corrective. They're going to be driving valuations here any more than the U.S. can necessarily control the value of the dollar. I mean, people always exaggerate this, I think. But there's no question that China is ready for some kind of relief. The retaliatory measures have been very, very bad for China's economy, just as the tariffs have been very bad for the U.S. So, like, nobody wins in this world. I've compared protectionism in the past to, like, the way they regarded bleeding in the 17th century. It's like they thought it was going to cure the patient. It's actually making everything much worse, and that's essentially what's going on here. So China at this point is not even trying to get a fair deal. They're just trying to figure out a way to protect their existing markets for their product and preserve their industrial infrastructure and preserve their vision for what China can be in the future. So yeah, they're in the table. They're ready to go. As far as the currency valuations, I think that's a much ado about nothing. I don't really put much stake in that.
So, Todd, while you just mentioned the U.S. has a glut of oil, it also has a glut of ags. China has agreed to up its ag purchases to $50 billion. In the context of China, though, total imports in 2018 was $1.7 trillion of ag imports. So in the meantime, given this, China has released a white paper today that it plans on securing its own food supplies, dimming hopes among overseas producers that Beijing will expand imports to meet domestic demands. So real quick, how much can China reduce food imports? Would the U.S. lose a substantial bargaining chip in the process?
They can reduce substantially because, listen, it's still a competitive market. They still grow grains in Argentina. They grow grains in Australia. So there are other markets. And the problem is not the tariffs. It's not the trade war. The problem is we have an oversupply and there's a choice we can go to buy. When the world runs light on supply, the Chinese will be forced to buy to get the food from us. It's really that simple. We don't have to have a big deal about it because at the end, there's an oversupply and there's a lot of competition. When the competition goes away and our supply dwindles down, they'll pay the price. They'll pay whatever it takes to get those grains over there. But the deal itself is not very good. $50 billion is a far cry from $1.7 trillion.
Jeffrey Tucker and Todd Horwitz, thank you so much for your time.